Okay, well, hello everyone and welcome. This is our traditional mid-year checkup. It's our economic and financial update as we are midway through the year, and we're really excited to share a lot of great information with you today. The presentation is going to be recorded. We will be sending this to you sometime before the end of the day, along with all the slides that are being presented. Let's jump right in and get into the discussion. Okay, so our halftime report, as I simply indicated. Okay, thank you. So we wanted to change things up a little bit since we're doing this virtual, and we wanted you to be able to ask questions in the course of the presentation. So at the very bottom of your screen, there's going to be a Q&A box icon, and you'll be able to type in your question. At the very end of our presentation, Sam and I are going to go through all your questions, and as far as the discussion is concerned, we're going to try to get through every one of the questions as best as we can. We did a program last night, and it was wonderful. We got to as many questions as we could, but unfortunately there were a few we couldn't get to. So, all right, next slide. Our disclosures, of course, customary. Okay, so one of the things we'd also thought we'd change up is we'd make this a little bit more interesting, a little more interactive by way of having polling questions. So we want you to participate and play along, if you will, and we're just going to do 2 practice questions just so you can kind of get the hang of it. So let's do practice question number 1. How are you feeling today? Great, so-so, I need a nap. Hit your answer, then submit. And we are going to have the results here in just a moment. And the results are, everyone got that? Okay, wow. We have got a lively, energetic group. Everyone, for the most part, is feeling pretty good. I may need a nap after this presentation, but that's something else. All right, let's close that. And we have one more practice question. And okay, will the Rockies win the World Series? Absolutely. Yes, but it will be close. Not our year. Select your answer, then hit submit. And we are going to then show you the results. And okay. Unfortunately, I think you might be right. 47% said not our year. However, they are off to a good start, but we'll see. We'll see what happens. Okay, so you get the idea, and we're going to be doing that throughout the presentation. So how we're going to do this today, the presentation itself is about 45 minutes. Sam is going to lead us through the next section of the presentation, and then I will follow to conclude our discussion. Let me first introduce Sam. Sam is a CFP, one of the wealth advisors here at the firm, along with Adam Dechtman, who's also a CFP. Both Sam and Adam are my sons. They're twins, and I couldn't be happier to have them both part of the Dechtman Wealth Management team. So without further ado, let me introduce you to Sam and have him lead us through the rest of the discussion.
All right, thank you, Jordan. So You can see the 3 bullet points here on your screen, but I'll read them off to you. First, we're going to begin with a review of the first half, discussing mainly what happened in terms of U.S. markets. Then we're going to be taking a closer look at the fundamentals that have been supporting the economy. And then we're going to finish up with a second half outlook and different market forces that could determine what we might see for the second half of the year. When we're also talking about the second half, we will also be spending some time going over the election, and we're not going to get into any political debates. We're not going to lean one way or the other. We have a few facts which we thought were worth sharing as we are nearing November, and definitely want to pay attention to that part. So let's jump right into the review of the first half. So what we're looking at here is a chart of the S&P 500 from January 1 through June 26th. And you can see its wild roller coaster-like ride, and we've highlighted certain points that we thought stood out to us in terms of the first half of the year. So if you go all the way back to January 15th to be exact, the US and China signed phase 1 of a trade deal. At that time, US and China relations were actually starting to improve. Can you believe that? It was only 7 months ago. How long ago does that feel right now, given where tensions and everything between the US and China resides? And really, when you started to see a steep decline is towards the end of February, when health officials warn of a significant disruption due to COVID. By late February, we had already understood what was going on in China, but didn't know if this sort of a virus was going to be spreading internationally. And then in March, President Trump instituted the European travel ban and also gave a thought that COVID-19 could extend into August. And here we are, middle of August, and it's clearly not going away anytime soon. So you saw the market continue to go down at that point. But then in April, things started to pick up, and towards the end, you saw positive results for a clinical trial. And then in May, you saw the Fed commit a significant amount of capital and a significant amount of resources to help keep the economy on board. In fact, the Fed is arguably the most accommodative they have ever been. So you have a Federal Reserve, which is doing everything in their power and even expanding those powers to keep the U.S. economy afloat. And you also have our federal government as well, and including Congress, of course, that is doing things to really help us in that regard. And so you've seen the economy slowly come back in May, and in June, you saw a brief dip because we saw a resurgence in cases on parts of the economy that began to reopen. Now, the way that this graph looks, we don't expect this deep of a decline between February and March for the second half of the year, but in terms of volatility, we think that that is here to stay, and really want to caution folks who think that we are out of the woods. We certainly don't think that that's the case. So what really drove U.S. equity markets? Well, before we jump into what drove them this year, for those that have attended presentations like this in the past, we always like looking through a historical lens. So what we're looking at now is 20 different leading economic indicators, and this is what they were showing in January 2010. And what's important to know is that these indicators are like stoplights. So green is good, yellow is caution, red is bad. So of the 20 you see here on the screen, 17 are green and 3 are yellow. So just a year after the financial crisis ended in 2009, things were looking much rosier in terms of the economy. Of course, it wasn't perfect. It took years to get back to where it was, but the outlook was starting to improve significantly. Fast forward 10 years to January of this year, we have 20 green, 8 yellow, and 2 red. So majority.
No, Sam, not 20.
There's 10 green,
10
8 yellow, and 2 red. Okay. And so with these indicators, you're seeing that the majority of them are positive. Now, there are some different cautionary metrics that are highlighted here in yellow. And as we highlight in previous presentations, the 2 in the bottom right-hand corner seem to be stuck on red for, who knows, an indefinite future. And for those that maybe can't read, it's the political environment and geopolitical risk. Again, we're not discounting how important those two are to the overall market, but we generally, have seen them red for a number of years, and unfortunately, we don't expect that to change too much. But if you fast forward now to June of this year, you saw the indicators change into a little bit more of a negative tone. So you have 4 green, 9 yellow, and 7 red. So everyone knows that when the economy had shut down and businesses were told not to open and people were told to stay indoors, that had a massive effect not only on individuals but also on businesses. You've already seen some historic retailers already file for bankruptcy, as well as other countries. And we're going to get into this here in a minute, but we think it could take years, quite frankly, for the economy to get back to where we were prior to the COVID-like shutdowns. Now, that doesn't mean that we aren't already starting to see improvements, and we're going to go over this here in just a minute. But to highlight maybe a few different areas to keep your eye on, one would be this cautionary metric you're seeing here in terms of housing and mortgages. So when you had the economy shutting down and the fear from the coronavirus was first showing itself here in the United States, many people that were looking to sell or buy homes were not comfortable either opening up their home to strangers or going into strangers' homes to view that, let alone in some parts of the country, buying a home wasn't necessarily considered an essential activity. So now that you have seen some reopenings and people are wearing masks and different guidelines, we've already seen real estate sales start to pick up pretty significantly, especially here in Colorado. So this is a number that or really a metric that we're taking a look at now, and what we think could go back to green territory here in the future, given that interest rates are so low and there still seems to be quite a demand for selling and buying homes. So next, we wanted to take a look at how bad this recession could be compared to the past. So what we're looking at here is a graph of the Great Depression and post-war recessions. Each of these circles, the size of the circle represents how bad of a recession or a depression that it was. So if you look in the top left-hand corner, the biggest circle, not a surprise, is the Great Depression. And so the Great Depression contracted the economy 26.7%. And on this y-axis, you can see how long that recession had lasted. So the recessionary period was between 3 and 4 years. Now, that isn't to say it took the economy 3 to 4 years to get back to where it was. It meant after 3 years, the economy stopped getting worse and started to once again improve. So where are we today? We're here in this bottom right-hand corner where you can see that our current recession has declined. Our economy estimates would be 12.8%. Now, early metrics that we're seeing in terms of June and July and even August have indicated that our economy has once again started to grow. So there's a mostly accepted belief at the moment that we are already out of a recession, but we won't actually know this until a few months down the line later this year, because all economic data is looking through the rearview mirror at what already happened. So a question we got last night in terms of our presentation and recessions is, when is a recession over? So a recession is technically over when your economy stops contracting and starts growing again. So just because things are not perfect doesn't mean that we're, according to economic textbooks, still a part of a recession. And we have already seen a lot of indicators start to show people are getting back to work, and that as the economies are opening, consumers are starting to spend a little bit more from the lockdowns of March and April. So we're optimistic that this growth can hopefully continue and we can get back to where we were hopefully sooner than later. So we've touched on it, multiple times now. You can't tell the story of what happened in the market or really society without getting into the COVID-19 pandemic. So now we're going to discuss the historic Fed intervention and fiscal stimulus, as well as different economies measures for reopening. So the first polling question that we have relates to the historic federal stimulus. So let me launch the poll here so everybody has it. All right, beautiful. The federal government has provided $2.441 trillion in coronavirus relief. The relief represents what percent of the annual US GDP? We have 14.3%, 23.1%, and 11.8%, and 8.7%. All right, I'll give folks just a moment here to put in your answers. All right, just one more second. All right, looks like most people have voted. So let's see what people thought. So the most popular choice in terms of what percentage of annual US GDP was provided for coronavirus relief, and the answer, which most of you had guessed, is 11.8%. So let's show you a breakdown of what that looks like. So the $2.441 trillion, which represents 11.8% of our annual GDP, is broken up into these different buckets, which we've highlighted. The top one, which most are familiar with, is the one-time recovery rebate checks of $1,200 given to each adult and up to $500 per child with certain income phase-outs. The next, we saw the boost to unemployment benefits, adding $600 per week to every check. And so these numbers are what has already passed. We know that there was an executive order to extend some of these benefits for a period of time, but we expect Congress to eventually come to a resolution to come out with some more stimulus. So these numbers are likely going to get even bigger and bigger. There was grants given to airlines and also businesses deemed important for national security. You saw the small business relief in terms of the PPP loans, if you've heard that, some aid to state and local governments, as well as health and other spending and tax breaks. So I touched on this at the beginning of the presentation, but this is just the measures that our federal government has provided to help keep the economy and the stock market really on track. We've also seen the Federal Reserve provide monetary policy that we've never seen before. They've opened up different lending facilities, which basically just keep liquidity moving. They want the pipes flowing in terms of the financial markets, and they've lowered short-term interest rates effectively to zero. So not only is the federal government doing historic things to keep the economy afloat, you've also seen the Federal Reserve implement different strategies that have never been used before in crises, and they continue to want to be that backstop to make sure that there is liquidity in the market to prevent another 2008 from occurring. So inflation. Because we've seen the Federal Reserve print trillions of dollars, more money is working its way through the economy. And because you've had some businesses shut down, we've seen supply in a lot of different areas be limited. So when you have more dollars fighting over a limited amount of goods, the economic reasoning is that we should see inflation. And this is absolutely something that we are keeping a watchful eye on, because a huge increase in inflation is very detrimental for all investors, especially those that are in their retirement years. So we're very mindful that we could see some inflation, but we're not ready to say that it's going to happen immediately. Once 2008 had happened and you saw the Federal Reserve lower interest rates to near zero, everyone was saying that by keeping them so low for so long that we should have seen inflation over the past 12 years, which never really materialized. So while yes, we do think that inflation should pick up, we want to make sure that we really are seeing that materialize before we begin to make wholesale changes to portfolios. But yes, we do see inflation increase, that definitely would be a problem. So now let's take a look at the labor market. And what you're seeing is two lines. One is the unemployment rate, and the blue line is wage growth. So the 50-year average for the unemployment rate is about 6.2%. Now we saw that peak earlier in April, somewhere around 14%, but since then, the reading that we have here in July, it's come back down to 10.2%. And in terms of wage growth, in July, our reading was 4.6% in terms of wage growth. So we still have millions and millions of Americans that are unemployed, or they're not being used to their full capacity, meaning they were a full-time worker, but they had their hours reduced and became part-time. Now, we are hopeful that different policies can remain and be put in place to encourage more businesses to hire their employees back. We're hopeful that economies can safely and smartly reopen to get these people back to work. But we understand that getting the employment rate back to where we were in January before this all happened, which was at 50-year lows around 3.4%, getting anywhere near that number, or even 4%, may take until 2022 or even 2023, quite frankly. So what we're going to be looking for now in the next months and years to come is, what is the trend of the unemployment rate? Are we trending down? Is it moving sideways? Or, hopefully we don't see it start to move backwards. So before we get into second half headlines, wanted to go over a few that could really disrupt what forecasts and really what we could expect in that rate. So on here on the left, you can see COVID-19 treatment approved. If there is a vaccine, this would be a very positive thing for the market. And I say that because having a vaccine would remove one layer of uncertainty from the market. Above all else, investors hate uncertainty more than bad news. And that's really why, when we were looking at the beginning, that huge decrease in February and March, because everything was uncertain. What type of a virus are we dealing with? How deadly is it? How does it spread? Can asymptomatic people spread this virus onto others? The economy is going to be locked down. How long is that going to happen? When are we going to resume normal life? And you saw it start to regroup a month later, or ish, in April, when a little bit more facts came out and we saw that the economy was going to be able to slowly start to reopen, hopefully in the second half of the year, which is what we've seen. So a vaccine just tells us that, okay, there could be an end in sight, but there's still a lot of questions that still need to be answered. How many are going to be manufactured? Who's going to be the first people to get the vaccine? Are people actually going to take it and trust that it happens? So there's still going to be a lot of questions, but it moves us in the right direction, and we think that that would be very positive news. And a question that we've gotten a few times is, should I invest in a biotech company that I feel could potentially produce the vaccine? Is this an opportunity you're looking at? Is this an opportunity that we should be invested in? So our answer is, we don't recommend, in terms of a balanced, diversified portfolio, really investing in any individual names. We think that you're putting too much concentration, and generally speaking, it's not worth the risk. And especially as it pertains to a company that could potentially produce the vaccine. One, if you were to invest in a company that you think is on the cutting edge and they're not the ones who actually win this, race, their stock price could get hurt very badly. But even if they do win, there's no way to determine how profitable it could be, because now it is both politically popular on both parties to try and limit biotech companies' profits. So it's reasonable to assume that if someone comes up with the vaccine, the government could essentially say, you need to manufacture billions of these and you're going to do it at cost. We don't want you to make any money profiting off a pandemic. And so the last headline is, Americans elect a president. So whatever president you would like to, be in there, and maybe one that you don't favor, both are going to move the markets one way or the other, and we don't know which direction that's going to be till we truly understand what policies are going to be put in place by both candidates. So now let's get into the second half and different market forces related to that. So when we're talking about fundamentals and we're looking forward in terms of the stock market, one thing that we are keenly aware of is earnings and corporate earnings. So what we're looking at here is a chart of the S&P 500 earnings per share from 1998, and then you see some projections here on the far right-hand side. So these little green bars are highlighted as what's called an earnings recession. And what that means is that earnings have decreased from a previous high. So if we look here on the right-hand side, this would be 2020. The estimates are that earnings for 2020 will be less than they were in 2019, thus putting us in what's called an earnings recession. But if you look in these other two bars, which would be 2021 and 2022, analysts forecast that we could have better earnings, moving forward to where we were. So a question you might be asking is, why is the stock market doing so well when the economy is doing so poorly? They're not moving in the same direction, and this doesn't make any sense. So we've shared this in previous presentations, but the economy and stock market are different things, and now is possibly the greatest example of that. So economic data, again, is looking through the rear view mirror. It tells you what has already happened. The stock market is a leading indicator and tells you where we expect to go. So while, yes, in 2020, we do expect earnings for the S&P 500 to be significantly below where they were in 2019, but the expectation is that in the future, in 2021, 2022, and beyond, we expect them to pick up once again. So when you're investing in the stock market, it's not just taking a look at your company's prospects today. It's how are they going to be looking in 10, 15 years down the line. Another area that we're very aware of is U.S. Treasuries and what we call the U.S. Treasury yield curve. So for those that have heard us say this but have never actually seen what it looks like, we wanted to present you with a chart of that. So on the bottom here, this shows you the maturity of a Treasury security. All the way here on the left, you have a T-bill at a 3-month rate, and all the way here on the right, you have a Treasury bond with a 30-year maturity, or a 30-year Treasury is how you may have heard that pronounced. So the one area we're going to focus on here is the 10-year. So in 2013, December 31st, 2013, a 10-year U.S. Treasury was yielding 3.04%. As you can see, in 7 or so years since, rates have dramatically decreased, from that point to where they're at now at the end of June of 66 basis points. So the point that we're trying to emphasize and make with this slide is that investing in bonds and really getting that nice interest payment from them is not as simple and is not as easy as it used to be. It's much more research oriented on our side and making sure that we're putting together the best portfolio so you actually can continue to get some yield on the bond spectrum, even though it certainly is a little bit more of a challenge. But as always, we do feel that beyond the performance and yield that you're going to get on a bond, their greatest benefit is really a diversification from stocks. And treasuries are a perfect, nothing is perfect, are a great diversifier, from the stock market. So we've talked about historic federal government intervention and stimulus into the economy. So wanted to show you this chart and really ask the rhetorical question, will taxes increase? So what we're taking a look at here is what's called the demographic support ratio. So on the y-axis, you're seeing the number of workers in the economy to retirees. And this green line is Japan, this light blue line is the Eurozone, and this darker blue line is the United States. So as you can see, in all three areas of the world, we're seeing the number of workers that are able to support the number of retirees steadily decreasing, and we expect this path to continue. So I'll ask the question again, will we see taxes increase? Who knows? But we think the path of least resistance is probably up. So this presents a lot of different planning opportunities that Jordan's going to discuss here at the end of the presentation, but I believe that we could be in a period of the lowest taxes that we may see for a while, just to support the same systems that we have come to love and enjoy. And if we continue to provide more stimulus and more and add on more benefits, it's going to provide more of a strain, which can only be solved by really increasing taxes. So while we've painted a mixed review in terms of sort of a grim outlook in terms of the economy now with shades of optimism, and then on the other side, the stock market has done well, and we expect to, be volatile, but keep up its current pace. I wanted to show you that tough times have birthed some of the world's leading companies. So McDonald's emerged in 1948 following a downturn caused by the U.S. government's demobilization from a wartime economy. Walmart came along 14 years later around the time of the flash crash of 1962, a period when the S&P 500 declined 27%. Airbus, Microsoft, and Starbucks were founded during the stagflation era of the 1970s, a decade marked by 2 recessions and one of the worst bear markets in U.S. history. Not long after that, Steve Jobs walked into his garage and started a small company called Apple. History has shown us that strong businesses find a way to survive and even thrive in volatile markets and difficult economic conditions. Companies that are able to adapt and grow in tough times often present attractive long-term opportunities. And the greatest example from the 2008 financial crisis and what emerged from that is Uber. I would venture to say that almost everyone, if not everyone, has either taken an Uber or some other ride-sharing company, or at least has heard of it. And the company's only been around now for what is 11 years, or maybe a little bit less. So what companies are going to emerge from this downturn? There's going to be opportunities, and it wouldn't surprise me if we have another behemoth in the United States as a result of the current environment. So now let's go to the next polling question here. We've been getting a lot of questions on gold, so wanted to pose a question related to that. Since 1980, how much has the value of gold increased? 20 times, 10 times, 6 times, 2.5 times. I'll give folks just another second to put it in there. All right, I think that's pretty much everyone. All right, so the majority of the audience felt that gold has increased 6 times since 1980. The next most popular choice was 10 times, followed by 20 times, and the last place answer was 2.5 times. The answer is gold has increased 2.5 times since 1980. So let me show you this next slide. So if you had invested $1,000 in January 1980, today it would be worth, so if you put that $1,000 into the S&P 500, it would be worth $29,000. If you put it just in an investment that purely tracked inflation, it would be up to $3,300, and if it were invested purely in gold, it would be $2,500. So many folks have been seeing different headlines, and you may be wondering, is gold a good investment? I know it's at an all-time high. So I want to first show the statistic to say that historically, gold has not been a great place to be invested. And another few points that I want to bring to your attention is since 2011, gold has not set a previous high. So if you were worried after the financial crisis and felt like gold was a good investment because it was a safe place to be, you would have made absolutely no money within the last 9 years. And in fact, it wouldn't have even kept up with inflation until earlier this year. So why are, beyond the numbers that you're seeing here, why don't we view gold as a long-term allocation? And the answer is that gold is just a metal. It produces nothing, it yields nothing, and is entirely without intrinsic value. Gold is like a commodity where its value is only as important as everyone else believes it to be, and really the demand for it. In terms of your portfolio, we believe that the best long-term way to balance it out is not to have gold as a part of your investments. We feel that having stocks and bonds is a much better way to have you invested, and the best hedge against inflation in terms of the investment universe really continues to be stocks. So now we're going to get into the election. Again, we are not going over anything political. We are not giving our take on who we think could win. We're not giving our take on who we would like to win. We're just going to be going over the facts and charts, and we'll just jump into that right now. So what you're looking at here is a chart of the S&P 500 from 1933 all the way through the end of 2020. And what you're seeing is these blue lines of the chart signify when there was a Democratic president, and the red line signifies when there's a Republican presidency. And as you can see, over time, during each a Democratic and a Republican presidency, there's ups and there's downs, but they continue to climb at roughly about the same amount. So now we're going to go to our next polling question here. And let me launch that. All right, since 1950, when there is a split Congress, the stock market has had similar results under a Republican or Democratic president. True or false? All right, we've almost gotten everybody. Perfect. So the vast majority of you, 83%, said true. So under a split Congress, the stock market has had similar results under a Republican or Democratic president, and that is correct. So what we're taking a look at here is the S&P 500 from 1950, and we only were able to update this chart through the end of 2017. Had we updated it through the end of 2019, you would see that when you have a split Congress, and here's on the left-hand side under a Democratic president, and the right-hand side under a Republican president, would have been practically the same. So do we favor certain policies over others that we feel could help the stock market and the economy? Absolutely. But when there is a split Congress, historically speaking, it doesn't make too much of a difference in terms of the market, depending on if your candidate is the one that ends up in office. So now I'll turn it back over to Jordan to discuss the fundamentals and really bring us home.
Thank you, Sam. Appreciate all your input. So when we take a look at the big picture and focus on the economy and how the markets are going to react and respond, it's so important that we focus on the fundamentals. There's a lot of noise out there and a lot of distractions, and it's very easy for us to get pulled in one direction or another. We are always deeply rooted in a quantitative analytical approach to helping advise you and guide you. So if we take a look at our slide here, something you might have seen from prior presentations, but so important and worth talking about. The point that I want to make today is that there is a very big distinction between risk and volatility. Volatility is something that's normal, and that's what you're seeing here on this chart. Risk, we'll talk about in a moment. It's a very different topic. So with regard to this chart, what you're looking at is the S&P 500 over the last 40 years. So from 1980 through June of 2020, over this 40-year time frame, if we take a look at the gray bars, what you're looking at is the S&P 500 year-end return. But during the course of the year is the red dots scattered throughout. At one point or another, the S&P 500 was down that amount. So if we turn our attention to the far right section of the screen where it says year to date, at one point earlier this year, first quarter, the S&P was down 34%. However, the S&P has not only rebounded, but it is now in positive territory, and it is up right around the 4% range. So throughout the last 40 years, and we can go back beyond that, and you'll find a very similar trend, is that the S&P is positive. And in this example, out of the 40 years, the S&P is positive 30 out of 40 years. Well, if you do the math, 30 out of 40 years, that's 75% that the S&P is positive. In other words, 3 out of 4 years, you're going to be positive and 1 down year. That's normal, and that's to be expected. The intra-year declines throughout this 40-year period, the intra-year declines average almost 14%. Now, it can be scary, and it is scary, especially when we go through what we've gone through. But I can't tell you how many times someone tells me, but Jordan, this time it's different. Well, yes and no. None of us have ever experienced the enormous pandemic like we all have went through and still going through. It's different, but it's very much the same. Historically, the S&P over this 40-year period and all the way back to 1926, so over a 90-plus year period, the S&P has averaged right around 10%. So we want to focus on fundamentals, keep our eye on the ball, and focus on the long term, and not be dissuaded or pulled in one direction or another due to emotions. If we take a look at the long-term focus, on the left-hand side are monthly returns. This is a chart that goes back many, many years, and it's the same 40-year time horizon. And you can see on a month-in, month-out basis, it's a coin flip. 50% it's up, 50% it's down. It's hard to predict. But if we take a look at the chart on the right-hand side, you can see that that is a 20-year rolling return. Throughout markets history, there has never been any 20-year period where the market has been negative, ever. And you can take any 20-year period and dissect it any which way. So naturally, we're focused on the long term. All right, let's go to question number 4. Sam? Okay. So the question is, will current interest rates in a savings account outpace inflation? Yes or no? All right, we want to do this quickly. And the drum roll, please. And overwhelmingly, 98% is no. And that is the correct answer. So what we're looking at here are cash account returns. Your very far right gray bar is showing the current income generated in a savings account based on $100,000. It's incredibly low. In fact, I've seen some statistics where it's an all-time low, which is interesting. And it's expected that rates are going to remain low. As Sam indicated, the Federal Reserve is going to be very accommodative for as long as they need to. So what we're suggesting is putting cash to work, finding a better home, and looking at opportunities, what that might look like. Real specifically, I just want to point out that we're looking at short-term treasuries, or we're looking at corporate bonds. We can talk to you more specifically about ideas that would be great opportunities as an alternative to cash. Our job here at Dechtman Wealth Management is to be your go-between you and making a big mistake. During times of uncertainty and volatility, a lot of investors are emotional and unfortunately sometimes irrational. We want to be the rock and the voice of reason. We want to be there to help you. So in summing this up, we're looking at planning opportunities. This is an ideal time, as we're midway through this year, to reevaluate your current allocations, to make sure that you have a proper risk-reward division between stocks and bonds, and making sure that everything is on track. Number two is we want to explore opportunities with what to do with cash now. So if you have money on the sidelines in a bank account in the credit union, we certainly have some options that we feel are very, very good alternatives. Number three, taxes are low for now. Sam touched on this, explaining that we think it's a foregone conclusion that at some point in the future, taxes have to go up. There's no question about that. So what are some planning opportunities that may make sense? It depends on your own situation. We want to look at the economics, run the numbers, and see what would be best for you. But again, a great planning opportunity to look at that now and come on in and talk. Lastly, we want you to come in. We're never too busy to help you. We're available. We've been working tirelessly through this whole pandemic. We've been in the office every single day. We'd like to meet with you in person if you're comfortable coming in, or if you'd rather talk on the phone, or we can do a Zoom meeting. But please give us a call, schedule a time for us to chat, and we'd love to sit down and talk. So this is the time we want to open this up for some Q&A. And again, at the very bottom, there's a Q&A icon. If you can just type in some of your questions. And let me begin by looking at what we have here. Okay, so we have a couple of questions. Sam and I are both going to go through these, but I'm going to start off. The question is, do the investments that we have track the S&P, the Dow, or whatever? And the answer is yes to all the above. However, we need to expand that because these portfolios are globally diversified. And no one client has the same investments that another person has. Everybody is unique and different, and they have a personalized strategy. So we look at US domestic strategies, we look at international strategies, both equity as well as fixed income. On the fixed income side, we have corporates, we have governments, and everything in between. So there is no one index or benchmark that we track. And again, that's something we can show you your custom benchmark and how it performs relative to your specific strategy. Okay, let's see another question. So a question is, what's the maximum dollar amount you recommend to leave in a savings account? And Sam, I'll just take this one again. Um, I don't know if there's a right or wrong answer to that. I think it's really dependent upon your comfort level. If you're comfortable having a certain dollar amount there in the bank or the credit union, then that's the answer. We would suggest that there's other alternatives that can provide a greater return on your money, and at the same time having liquidity and accessibility to the funds at a moment's notice anytime you should need it. All righty, getting a lot of questions here. Thank you. Okay, I'd like to hear your outlook on emerging markets. The demographics are better than ours. What's your outlook on emerging markets? Sam, you want to take that question?
Absolutely. And Bill, thank you for asking this one. We will have a one-off conversation to get into it in depth, but very broadly here for the whole audience, we view the emerging markets as an investment opportunity that we're keeping an eye on, but we're not quite ready to go full head of steam quite yet. And the reason for that is, generally speaking, in the emerging markets, they do not have as great of a healthcare infrastructure as the developed markets. So as they're continuing to deal with the coronavirus, and we're seeing deaths in these types of countries be at a pretty high rate, and we're also seeing stricter lockdowns than you are seeing in the developed world, for the sheer fact that there's not enough hospital beds and there's not enough resources in this healthcare for these emerging markets to really keep things on track. But if we do see a vaccine and there's some thoughts in terms of distribution globally, then I think that would provide more of a buying signal to get into the emerging markets. But very generally speaking, we think that the emerging markets are going to be a great opportunity, but don't feel that we want to be early in this type of a market, because the challenges they're facing, we think, are still pretty steep.
Yeah, thank you for that. And we are watching that sector very, very closely. We think that there is a lot of opportunities there. So expect to see that addition sometime in the future. Okay. Let's take a look at some of these other, let's just take, Sam, let's take two more questions and see if we can. So we have a question from Gary. Based on the Secure Act and taxes being low at the moment, do you recommend greater withdrawals from IRAs? Well, if you're at the age of where you're not, or let me back up, where you do have RMDs, so you're 70 and a half or older, you are not required to pull money out of your IRAs in this calendar year. With that being said, do you want to look at other options to lower the IRAs to minimize taxes in the future? In terms of a strategy, we have a strategy that we refer to as filling the bucket, where we do Roth conversions up to a tax threshold. We run the software, and that would be a terrific strategy to implement, certainly in this calendar year and maybe the next couple of years. So I think the planning opportunity is now rather than later. All right, Sam, let's take one more question. And okay. Okay, we're getting into some of these political questions, and we'd prefer not to get into any sort of specifics. But with the historical data in regards to one party over another, the statistics are very clear that when there is a split Congress, regardless of who is in the White House, the markets historically have performed as well as they can. So you may have your certain preference for president, but at the end of the day, we want to make sure that we have a balanced system of checks and balances, and hopefully that process will continue to work as it has over the years. So there's other questions, and it's we're really out of time. We thank you for your time and your attention today. Please give us a call, schedule a time for us to talk, whether it be in person or on the phone. We love to hear from you. And at this point, on behalf of all of us at Dechtman Wealth Management, thank you so much. Look forward to talking to you soon. Thank you.
Thank you very much.